So, ladies and gentlemen, traders worldwide, welcome to another episode of the Market Talk series. As we gather here once a month to dive into the intricacies of trading, I'm really pleased to introduce you to the one and only Sunil. Just a few words about this gentleman. With an impressive trading journey spanning over incredible 3 decades, Sunil has honored his skills and become a source of knowledge for traders around the globe. He's an author of the 7 Secrets for Professional Traders, which explains the strategies, mindset, and principles that really separate the best from the rest in the trading arena. He's also the CEO and founder of the FIP Forex 123. He's a trader, a coach, and mentor for thousands of traders. In this Market Talks episode, we will tap into Sunil's trading insight and, of course, his strategy. So, Sunil, welcome to the Market Talk episode. How are you doing today?
I'm doing good, Theo. Thank you so much for getting me over here. It's a pleasure to be here, and I'm really looking forward to meeting people, sharing information, and talking to traders.
Yeah. Sunil, it's our pleasure to have you in our show. So we have a lot of participants, and of course, just allow me for 1 second to say again, hi and welcome to everyone. Okay,
welcome to everyone.
There are many people, you just read the names, they join the daily live trading webinars we host here at Admirals, and I'm sure they can't wait to hear how you will explain and what you're going to say maybe about the FIP tools, as the name of your website. It's
Fibonacci.
Yeah. So I will ask you a few questions so we know you better, and we go through your strategies and everything, right? Now, how did you start your career, and what really tapped you into this world of trading?
Oh, that's a very interesting story, Theo. I'm from India, resident of India, and this is something which you, or probably a lot of people don't know. In India, even as of today, Forex trading is not allowed. But an individual cannot trade in the international Forex markets. We can trade currencies based on the Indian rupee, but the international currencies, we are not allowed to trade. So I'm a resident of here. I had my construction business earlier, which is doing quite well. Mm-hmm. And for some reason, I had to shift to some personal reasons, some home-based jobs. And I was doing some outsourcing work. And somewhere I came across currency trading. It was actually one of the spam emails. In those days, the internet was just about coming up, and I'm talking about 20 years back, 2001. I remember I just about started sometime that time. Something caught my fancy. Now, I have a background in mathematics. So I've graduated in mathematics, but gone into construction, family business kind of thing. But construction was, even though it was good, there is no scope to apply your brains. The architect draws the plans, you do the execution. That's about it. Yeah. Somewhere when I came across these charts and technical analysis and started applying mathematics to it, it kind of fascinated me. That was one of the reasons. And second thing about trading, which has always been on the back of my mind, we Indians are huge in trading, the stock markets and all over here. So it's entirely your responsibility. I mean, you make profit, it's yours. You make a loss, you are to blame, period. You cannot blame the market, you cannot blame the circumstances. So that is something which I always wanted to do, not be dependent on somebody else. And mathematics and technical analysis kind of came together. I started off very honestly, like every trader, which I advise today to a lot of traders. I bought some books on technical analysis. I did a lot of Google search. I opened demo accounts. Everything was hunky-dory, going fine. Then I opened up a live account with not a very large amount, but I kind of blew it up in almost a month. And it was back to the drawing board. So took some more indicators, having mathematical background, tweak that indicator, tweak this indicator, and said, okay, now I'm confident enough. So opened another account that must have lasted me maybe 2 months. And it went on as a series of losses, believe me. But there was one thing at the back of my mind, which was that if somebody is making money, then there has to be a way. I'm doing it wrong. I need to find out what I'm doing wrong. And the irony of it all, Theo, is it took me more than a year, literally. I mean, I never really made money. I made some money, but eventually I gave back everything to the market.
Yes.
I became so good at technical analysis that I started writing articles for magazines. I've been a writer since those days. And these guys would pay me maybe small amounts, but I made money by writing, but not by trading. So it was a bit of an irony till I realized what I was doing wrong, and which is what I describe in my book. But till that time, I described what I was doing wrong, and that kind of changed things around. Still took me a lot of time to become consistently successful. Now, as traders, we want to be consistently successful, and we don't want to make money 1 month and blow the account the next month. If you're looking at this as a career, something which you can make a living from, it's a long process. It takes a lot of patience, a lot of determination, a lot of hard work. But at the end of the day, if you make it, there's no other business like it. So I came into it by accident and just been stuck since then. I took a fancy to it and I said, this is what I want to do. And that's how I got into trading.
Wow.
So, yeah.
It's really interesting. And coming from the background of mathematics, I honestly can associate with you because I have the background in physics.
Oh.
And it's like our brain, it works more structured somehow, and we are more systematic traders.
Absolutely.
Without meaning we based only on the algos, right? I mean, just to find some indicators.
Right.
So, which is the indicator that you honor your success, let's say, or which indicators helps you believe that you can keep on going and smoothing things down the track?
No indicator. No indicator.
Okay.
Trust me on this. I mean, I've studied each and every indicator in detail. And the first advice I would give to everybody is, and we'll go into it in detail, I'll honestly demonstrate this to you. All indicators are lagging. It's just as simple as it. You can use them as secondary confirmations, yes, as a kind of confirmation that, okay, you're in the direction of the trend, etc. But the minute you start using an indicator as a leading factor for your trading parameters, that I'm going to use the indicator to enter a trade or exit a trade, you're headed for trouble, believe me. And I do use only one indicator. I can share my charts. In fact, I've put up a small presentation. It's only to identify my primary trading method, which is the divergence. And that's it. Once I see the divergence on that, then I don't go back to the indicator, but no indicator. And this was a defining movement for me when I realized that risk management and price action, these are the two key things if a traders follow, it ensures faster success. That's about it.
Okay, awesome. We're going to go to that part. Very interesting and extremely well explained. I'm sure everyone have a few aha moments now, because we always say it's especially for the moving averages, right? They are lagging indicators, and they are still traders looking to execute from the bounds of the moving averages.
Absolutely. No, as I said, there is a way to use them, absolutely, but in the correct way. That's it.
Yes. Yeah. So, explain us a little bit about how do you perceive technical analysis? Because we talk about charts, we show all the time charts, yet we read price action. So technical analysis is the primary method of your trading, or do you use fundamental as well, or do you validate something, let's say, based on fundamentals? Because we trade currencies, right? And they are dynamic changes in the market. Can you walk us through a little bit? What's your thoughts and what do you do?
The primary reason for me to stick to the Forex markets is Forex is a very unique instrument. The currencies are very unique in the sense that this is the only instrument, if you can call about, among equities, commodities, futures, derivatives, anything you would talk about. This relies more on technical analysis than fundamental analysis, which has a big advantage. Now, yes, you are trading currencies. In effect, you are trading the economy of a country, to be very honest. So obviously, you need to be aware of the strength and weakness of the currency. But those work on a very macro level. As retail traders, I mean, an individual like you and me, when we are trading the market, we are retail traders. We are not institutes. We are not hedge funds. For retail traders, we don't look at the macro picture. We don't hold a currency for 6 months or 8 months down the line to see whether the economy would turn, whether the dollar would go stronger, euro would go weaker. We are looking to get in and out of the market. And for that, technical analysis best suited for Forex. It really, and that is one of the reasons what really attracted me to this market. So as a comparison, when you're trading equities, obviously you would look at the company performance, you would look at some government policies, you would select a company which is good, and then you would go to technical analysis to see what is the right time or level to get into a trade. With Forex is actually the other way around. If you look and you see a good level over there, and if you're a short-term trader like retail traders as we do, and I'm not talking about intraday, again, we'll get into that, but as a short-term trader, on the charts, what you see is what you get. This is a uniqueness of the market, so which Forex has a huge advantage. Technical analysis, you see something on the charts and you trade the charts. Fundamentals, yes, they do matter. News which comes out every week, I call them as catalysts which push price somewhere. So we don't really trade the news, but we take into account the news that it's probably going to affect the technical analysis somewhere. So you do keep a cross check on fundamentals, but on a very micro level. Primarily, it is technical analysis that you trade Forex on.
Wow, that's so well explained and clear. For example, can we give an example to our audience? Like we have let's talk about the upcoming non-farm payrolls. Okay, right. So and the week after we're going to have, let's say, the Reserve Bank of Australia report interest rates. And I think on Wednesday, the European Central Bank, I'm not very, I don't remember clearly, but for example, non-farm payrolls on Friday. And on Tuesday, the Reserve Bank of Australia interest rates.
Right.
How would you see this in your trading? Let's say if you want to validate a trading setup on the Aussie US dollar.
Right. One is non-farm payrolls is something I honestly keep out of. Again, there's a lot of hype on the non-farm payrolls. It does affect the currencies. When it's released, the currency can move 100, 200 pips in one direction or the other direction. But the only people who really make money in this are the brokers and the market makers, the banks. The retail traders don't stand a chance. And we will get into that a little in more detail. So as far as non-farm payrolls are concerned, if I am in a particular position by Friday, then I tend to either close off my position, or if I am in a decent profit, I'll probably take some profits and move my stop loss to break even. Let it ride. If it comes in my direction, fine. If it goes, I don't lose anything. Non-farm payrolls is only one economic data that I stay out of. The rest of them, we take advantage. Like, let's say, Australian dollar interest rate announcements. You're not going to believe this, and a lot of people don't really believe it, but I have seen it happen over and over again. And something which happens again and again cannot be a coincidence, right?
Yes.
There has to be a pattern behind it. Fundamental factors, the movement after the fundamental factors tend to fulfill technical patterns. I have seen this time and time and time again. So if I'm in, let's say, an Australian AUD USD position, and I see that AUD interest rates are going to be announced. Now, when the news is released, it could go either way. And you really don't know. Even if the interest rates are positive, the Australian dollar can go down. It just happens. But what I look at is technical levels on a larger scale. I'm more of a swing trader. And I see that post that, if it comes to my technical levels, that is the time I'll probably take a buy or a sell, depending on my technical pattern. So if the fundamentals fulfill my patterns, so I don't trade the news, I wait for 10, 15 minutes, let the news get settled down, let the riffraff, the novices get taken out of the market. Once it reaches a level, then you take advantage of that and it works. But you have to be prepared with your levels right in front. So as I said, news is a catalyst. And if you know how to do it properly, it can really help you do that.
Exactly. So the outcome of this is that Sunil himself never trades the news themselves.
Absolutely. Absolutely.
Okay. So you mentioned that you are a swing. Actually, you mentioned so many things. Okay. So you mentioned that you are a swing trader. You mentioned that you are in a short-term trading activity. Can you please explain us what do you mean by swing trader? Which time frame do you do analysis? Which time frame you do execution? And so on. And of course, you're going to walk us through your strategy, right?
Right. I will definitely. My primary trading time frame is a 4-hour time frame. So it's kind of swing trader. When trades, if I get into a trade, could last anywhere from maybe 2 days to maybe 2 weeks. Sometimes maybe even more, but generally about a week or so is what my trades look at. And the number of trades, honestly, that I get into would be about 5 to 7 trades a month. So I don't go intraday, and there is a reason for it. Intraday does not work in Forex. Contrary to popular perception that, it's a very tempting thing that Forex is a 24-hour market. It moves all the time. It's got huge volumes. It's got a lot of volatility. So the market is moving every time. I come across a lot of traders who say, how difficult is it to take 10 pips from the market, get out, after 1 hour, take another 10 pips, do this 10 times a day, and you've made money. Yeah, but you're forgetting two very important factors. You're not taking into account your brokerage, your spreads, which your Forex broker, unfortunately, because we don't have a central exchange, your broker is at liberty to increase or decrease the spreads whenever he feels like it. And there's nothing you and me can do about it. So your spreads can go haywire. You can get bad fills. Forex is a volatile market. You place an order, and in that 1 second, the market will probably move 10 pips ahead. You get filled 10 pips. So your profit of 10 pips is gone already over there. Plus, risk management is something which I define trading with. It does not work on smaller term time frames.
Okay.
Important factor, very important factor, which I will get into real detail because it's something which a lot of traders are not aware of. Forex mainly, like any market, can be, I won't say controlled, but they are run by large funds. There are large people who have enough volumes, enough capacity to move the market. And I'm not saying manipulate the market, but to move the market. Forex has always been the domain of banks. Before the internet started 20 years back, before Forex became, today you have 1,000 brokers. But anytime you wanted to exchange currencies, you had to go to the bank. There's no other way. Even today, physically, if you are buying and selling a currency, you go to a market maker, he also goes to a bank. Banks have traditionally been the currency exchanges, so they are the market makers. Now, today, banks are the largest participants in the Forex market. They are. As a retail trader, when you are trading, the opposite side of you, the other side, trading is simple. When you buy something, somebody has to sell it to you. Most likely, the opposite side of your trade is a bank. And do you think a bank trades on a 5-minute and a 1-minute time frame? They don't. They trade higher time frames, which is one of the reasons why I stick to higher term time frames, because I would like to, as I say, hang on to the coattails of these large funds, see what they do, and ride along with them. So if I see those levels on a larger term time frame, 4-hour is a very good time frame for me as a retail trader. I don't go daily because it's too far a time frame. I go on the 4-hour, I can come down to the 1-hour to refine my trades. I get my quota of about 1 or 2 trades a week, which I'm happy with. For retail traders who want to go a little more in number, I would suggest even the 1-hour is fine. You're still aligned with the larger participants of the market. Anything lower than that, you're reducing your chances of success. Honestly, that's about it.
Okay, that's really interesting, the whole explanation. And do you monitor any? So do you come back to the chart every 4 hours and then you continue your daily schedule?
Absolutely, that's one of the advantages of trading on a longer term time frame. How many candles of 4 hours form in a day? 6 candles. Even if I look at my charts 3 times a day, it's enough for me to manage my trades. When I do have time, which this is my full-time job, if I'm not really doing anything, I go down to the 1 hour where I can look at my charts once a day. But I do not want to go down to the 5 minutes and sit glued in front of the screen, watch price move up and down, because not only are you going to lose money, it plays havoc with your emotions, literally.
Yep.
So larger the time frame you go, it's always better. You have more times to plan your trade. Absolutely.
Which time frame do you use as your analysis time frame?
The 4 hours. The 4 hours is my primary analysis. We do follow multiple time frames, and it's no secret. I can tell you here for everybody's reference. So one is what I call as the execution time frame. For me, it's the 4 hours.
Yes.
You have to look at the longer term picture. Look one time frame higher for me, which is the daily. You look at levels of support resistance ahead. Just simply, I'm looking at barriers. So if I'm looking to buy a currency and I go to our daily time frame and I see that there is a supply level or there's a resistance level, which is very close to my trade, that means my trade does not have much room to go. I'll think twice about the trade. So I have the larger picture. And once I get into a trade, my analysis is done. Once I get into a trade, I refine my trades on one time frame lower, which is the 1 hour time frame for me. I can manage my trades. Again, this becomes, when we look at analysis, you look at a larger term time frame. But when price starts changing direction, it starts from a lower term time frame and starts reflecting on the higher time frames. So the 1 hour gives me a kind of an advanced warning if something is going against me, if it's going in my trend. So based on this multiple analysis, multiple time frames, the 4 hour is my primary analysis time frame.
Okay. Awesome. Thank you. So do you, before you said you have some slides to share with us, and before we go into that one, how does the Fibonacci tool comes into your trading life?
Okay,
you know why I'm saying that? Because I got very caught by your website.
Yeah. Let me start by giving you something very interesting. As a matter of fact, what I'm going to do is I'm going to share the slide of the Fibonacci, just to give you a very brief idea about what Fibonacci is. For those who are not familiar with the Fibonacci, that's one. Yeah, and just give me a moment.
1 second to help you be able to share your screen.
Yeah.
Okay, yeah. Now you can try.
Yeah. Okay, you can see the screen, right?
Yes. Fibonacci ratios.
Right. So this is what Fibonacci's are. So there was a Italian mathematician, Leonardo Fibonacci, who uncovered a mathematical sequence. So this is your mathematical sequence here. Right. I think I can annotate here. Share, withdraw. So this is your seeds. So it just starts with number 1. You keep adding the numbers. So 1 plus 1 is equal to 2. 1 plus 2 is 3. 2 plus 3 is 5. 5 plus 8 is 13, and so on. It goes on till infinity. So this is just a mathematical series. But the real value of this comes from the fact that let me see if I can remove this. How do I clear box? There we go. Oops. Yeah, sorry. You take any two numbers, like you take 21 and you divide it by 13, it'll always give you a ratio of 0.618. You take 144 and you divide by 89, it'll always give you 0.618. You take the other way around, you divide 13 by 21, it'll give you 1.61. I'm sorry, it's the other way around. 8 by 13 gives you 0.618. So any two numbers you divide, they'll always give you a 0.618. And this is known as the golden ratio.
Yep.
Now, interesting facts about golden ratio limit. How does it come into a market? I really can't explain when it came into the market, but humans trade the market. We have emotions with us. We trade on our emotions. Human body is filled with Fibonacci ratios. All right. Interesting facts. Two very interesting facts. If you take your entire length of your body from head to toe and you measure from head to your belly button, and you divide the two, it'll always be 0.618 in any human being. Right? You take the length of your arm from your shoulder to your fingertip, and you take the length from your shoulder to your elbow, and you divide the two, it's always going to be 0.618 in any human being.
Wow.
Just two common things. I mean, human beings, your teeth are in a Fibonacci ratio, your nose is, your eyes, they are in a Fibonacci ratio. I could go on and on. So my way of looking at this, humans trade the market. Humans are filled with Fibonacci ratios, which is why Fibonacci ratios probably work in the market. Now that's just a theory. But on a practical note, I don't know how it came into the market, but what we look at today is these Fibonacci ratios as effective levels of support and resistance. So the golden ratio 618 is considered to be an important level. Just as an example, is the simplest way of going through it is if you have a market which is moving up. Markets never move in a straight line. It retraces, pulls back down, and then it moves up if it's in an uptrend. Now, this move here, this pullback, what we are looking for is certain support levels over here. So the golden ratio is considered to be an effective support that if the price retraces to a 0.618, it has a higher possibility of moving up. So that's the simplest way of utilizing effective Fibonacci ratios, but going deeper into it. So it becomes a kind of a self-fulfilling prophecy. So a lot of traders are aware of this, and if price starts coming down to a particular level, they will place their buy orders here, expecting that price will probably stop at this level. So which is why there are a lot of buy orders over there, and a lot of traders do that. So effectively it works. So that's one of the reasons.
Okay, awesome. So going back to that example you said, Do you, by the way, can you show us your strategy? And then I will ask you a few questions about that one, because everyone here is curious. I see the comments. So how does he trade? What does he trade? You mentioned divergences. Can you please show us an example of a trade you recently took, or maybe you remember, or what you generally look in the market?
I do have a recent trade which I've put down a picture of over here. But to be honest, before that, it's just, so the effectiveness of the strategy is definitely there, but I would want everybody to understand the working of the Forex market first. What is the uniqueness of the Forex market? Why do any systems work over here? So if it's okay, let me first go through understanding the Forex market, because we are talking about Forex, and I'm sure a lot of traders here talk about the Forex market. So it is, I would call this as more like a defining moment of my life on how I realized, even after becoming successful, what it was, what really changed things for me over here. But I'll just give you a brief story over here, and then I'm going to go into the slides, because it's very important for people to understand, the working of the market, to really understand the strategy. Once I go into the strategy, once you understand the workings, obviously it will make a little more sense.
Yeah.
So I have been a speaker. I regularly take part in a lot of Forex expos the world over. And it was almost about 10, 15 years back, sometime in London at the World Money Show, I did a talk on risk management, right? And it was basically just risk management, nothing else. It was a big audience, about 150 people in the room, open session for everything. At the end of the session, an elderly gentleman come up to me. He says, your points of risk management are very precise, and I find them absolutely suitable. Would you be able to do a session for my traders on risk management? I said, sure. So what company are you representing? Are you a fund? He says, I'm the head trader for Bank of America. I was like, are you kidding? I mean, you guys trade billions of dollars, literally, and you want me to do something? So he said, no, we have our systems in place, so there's no question of the systems. I want my traders to have a little bit of discipline in risk management, and I think your points will suit them. I said, I have one condition, besides the payment part, of course. So I said, one condition, that I need to spend at least 2 days on the floor with them to find out how they're trading, so I can put in my risk management policies for them. That changed the entire way I look at the market. Now, I was on the other side of the market.
Yes.
And before I go into it, let me share my slides again. Let me show you something very interesting over here, something which, again, a lot of traders are not really aware of. So we all know that Forex has got the largest liquidity factors. It's got a turnover of approximately 6 trillion a day. It is one of the largest trading instruments worldwide. It beats all equity markets, everything, 6 trillion a day. But there are two little known facts about the Forex market. The first is almost 60 to 70% of this entire turnover is traded by banks. And these are statistics. So the Euromoney does FX survey every year. And this was 2020, where they have a group of 10 banks over here, which constitute about 60% of the entire worldwide trading, all right? Yep. This was 2021, which I've noted was 66.62%. You have JP Morgan, UBS, Deutsche Bank, Goldman Sachs, Bank of America. And the last one was 2022, 23 is not yet done. We have 65.9, so almost 66%. So the simple fact is, banks are the major players in the market. That's one thing you need to understand. The second important fact, which is not in public domain, is out of all this trading, almost 60 to 70% of this entire trading is non-deliverable, which means it's traded for speculative purposes. Now, taking a rough calculation,
wow.
60% banks And of these 60% is done by banks for speculative purposes. That means out of 6 trillion today, approximately half of it is speculative trading. This
Wow.
Now, if you go a little deeper into this, what would be the basis of the speculative trading, right? Let's talk about a difference between a genuine trading and speculative. A genuine trading is somebody approaches a company, approaches a bank. He has an export order. He needs to buy currency, sell a currency, hedges currency. The bank will assess they'll buy a currency in advance. So that's genuine forex trading purpose. You and me, we travel to a different country. We exchange money. That's genuine trading on physical trading. But speculative trading, if we are doing, what is it based on? Is it based on fundamentals? Is it based on technicals? No. These trading decisions are primarily based on taking out the stops of the retail traders. And this is what I got to know when I was sitting with the bank people over there. You know the language they use over there? All right. This is where the retail traders are going to come in. We'll drive price over there, and this is where we will kill them. That's the language they use. And they have the capacity to do so. So, as I said, before I get into the technical part of it, you need to understand this. And I want to go a little deeper into this. So this is related directly to supply and demand, which is created by these banks. They have the capacity to do it, right? Just a simple chart, plain chart, nothing else. Now, if you look at this, I have just placed on top anticipatory sell orders, on the bottom anticipatory buy orders. I always tell my students who come to me, my traders, that look beyond the charts, look behind what's happening. So if price turns down from here, the simple reason is that there are more sellers over there than buyers. That's as simple as it. If price comes down over here and starts moving up, there are more buyers than sellers. So effectively, it's just a supply and demand. If there are more sellers, price goes down. If there are more buyers, price goes up. That's it. Now, these banks, they place anticipatory orders. So if price is somewhere, let's say over here, let me just give you an annotation, just as an example, right? Let's say price is somewhere over here, and it keeps, maybe it's going up, maybe it's going down. Now, bank traders have already placed anticipatory sell orders here for whatever reason. It could be a genuine trading for a client. They might want to sell for a client. It could be speculative purpose, could be anything. Now, what this guy wants, if he has to fulfill his sell orders here, he needs buyers over there, right? It's just as simple as that. How does he create buyers? They start pushing price up. They start pushing price up. In the process, they make money because they buy over here and they start making it. And at the end, if you always observe before price turns, there is usually a very strong candle which goes up, which kind of attracts more retail buyers like us. Oh, price is going up. I see a big green candle. I need to get into the trade right now. And it runs into the stack of sell orders. Price turns down, the banks make money, the retail traders are left holding the bag. It's just as simple as that. This is how every market works. It's not only about Forex, this is how every market works. So what you actually have to do is go behind and just stop looking at the markets. And this is what retail traders do, all right? So let me just go through here. We use indicators. I have used moving average as we talked about earlier. When I say it's one of the most lagging, let me just show you something very simple over here. That where did this move start from, right? Let's talk about this move. Where did this move start from? It started from here. It ended over here. Now, there was a reason. There were a lot of buyers which came into the market. The bank started the movement. It went up. Any trader which trades on moving average crossovers, you have this moving average, you have this moving average. The moving averages cross over here. And where do you think they cross? When price is about to turn down. The banks know exactly. They know exactly what moving averages, indicators are used. They know how to attract the people, and they know these moving average crossovers. They know there'll be a lot of buyers coming in, which will fulfill their sell orders. Now, this is just what I call as the law of the charts. There's nothing else to it. It's not manipulated. Everybody does it. Banks have a competition between them. Some banks win, some banks lose. So it's just the way the market works. Now, understanding this factor. So I was very cagey. I was asking them, I designed some money management policies, etc. And then my question was, why are you placing a buy order here? Why not lower? Why are you placing a sell order in anticipation before price? Why there? But obviously they were very cagey about it. I mean, these are secrets handed down from trader to trader. But I clean out some information which I used for my own thing, but honestly, they did not tell me anything. Now, coming back to the method. My primary trading method is the divergence, all right?
Yep.
Come back to this. So we will talk about the 3Ms. We'll come back to this. The method that I talk about, it must be an effective trading technique based on the concept that institutional traders create traps for retail traders. I want to follow the institutional traders. So which is where I find divergence to be one of the most effective trading techniques. Within the divergence also, I have something which is called the class A divergence. Not many people are aware of that there is a class A and a class B and a class C divergence. So there is a difference between them. Not all divergences are effective. The class A is one of the most effective, but this is a concept behind the divergence.
The most powerful, actually.
It is. Yeah. It is. And if you understand the concept behind it, you know why it works so well. So you have this support level and price comes back to the support level. A lot of traders will probably place a buy order and they'll keep their stop loss below the support level. The price goes up. For some time, a trader's happy. Oh, I'm making money. It goes up. And then it starts coming down again. And the institutes will drive price just one wick down, clean out all the stop orders, and then your actual trend starts. And this, in effect, creates the divergence. Now, if you look at this, this is a bullish divergence. And this is created by institutes, which is what I want to trade. So my primary trading instrument or method is the divergence. Now, we have taken it to the next level because we trade the class A divergence. We have added a lot of Fibonacci ratios to it as confirmation. And as I said, I'm going to show you one trade example over here. This is on the Euro USD last week, just last week on the 4 hours. All right.
Yep.
Everything was going with the euro. I mean, it was in a downtrend. It's been in a downtrend. So it's been in a downtrend. So obviously, we were also looking at a sell trade over here. What happened was we were waiting for price to come back to a resistance. And it came up to a nice resistance level. This was a place where a lot of traders would probably get into a sell. Downtrend, price come back to resistance. Obviously, it has enough information, good chances of it going further down. But we are aware of these things. And one thing I would honestly talk to traders over here is when you are trading, I am a technical trader, or I would say that this is my advice. So I will not trade unless I get a pattern. So price is in a downtrend, fine. Can I just jump into a sell trade? No, I'm waiting for a pattern. And my pattern is the divergence. Unless I don't get the pattern, I will not get into a trade. So obviously, I am not going to get into this level over here because I don't have a pattern. Price goes down for some time. And then again, it comes up and you see this wick over here, right here. Takes out all the stops of this and then price comes down. Now this wick created the divergence. You see, this price made a higher high, and your indicator, which is stochastic, the only one that I use, made a lower high. And that is what I wait for. Once I see this, I don't go back to the indicator at all. I don't need the stochastic. I confirm with Fibonacci ratios that if price has a possibility of turning down from here, it has to confirm certain Fibonacci ratios which I plot. If it confirms that, then I set my target using the Fibonacci ratios. My entries are based on supply, demand, and on Fibonacci ratios, and even simple things like trend lines. So I would probably plot a trend line from here. On breach of a trend line, I would get into a trade. Advantage of using Fibonacci's is I have a target. So my target is somewhere over here. I know that even if price comes down and starts retracing for some time, the possibility that price will go to that is very high because Fibonacci's tend to work well. So I remain in the trade. I don't panic. At the most, if I do tend to get some panic, which happens to everybody, I might just close half of my position over here, move my stop to my entry and my break even. That if price goes up, okay, I walked out with 50% of the trade. I'm still in profit. But if it goes down, I'm still making more profit on half my particular lots. And that is just how I trade. It's just as simple as that and nothing very different about it.
And very powerful and effective, right?
Absolutely. Simple, effective, powerful. You don't need to complicate things at all. That's it.
Can I ask you a question? Do you look at price action, candlesticks themselves, any candlestick patterns maybe you validate more as dynamic shifts in the momentum when they come to a level of resistance?
Yes, I do. But just one very cautionary note over here, candlestick patterns, especially in Forex, one, there are very restricted amount of candlestick patterns which work on Forex. If you look at the candlesticks, the patterns by itself, there are about more than 50. And Steve Nissen in his book has described more than 50 candlestick patterns. Most of them are with gaps, which work in the equity markets. Forex, we don't have gaps. So half of them, we really don't apply it in Forex. Some of them are effective, but they are effective only on higher term time frame.
Yes.
Daily and 4 hours. Below 4 hours, no.
Too much noise, huh?
Exactly. There's so much of noise over there. And understand one important thing. Forex is a global platform. There's no central exchange. I trade with a broker who's probably based in UK. You trade with a broker who's based in the US. Somebody in Japan is trading the broker who's based in Japan. Now, if you look at the different time frames, obviously, if I'm looking at a candle pattern, the candlesticks will also be different on different time frames.
So well explained.
So you cannot go to a 1 hour and say, okay, I have a hammer and I'm going to sell because I have a hammer. It makes no sense. Daily is fine, 4 hour to a max, not below that. Yeah. But yes, candlestick patterns definitely work. Absolutely.
Do you look, let's say, because you mentioned hammer, it was also a hammer on that example you shared before.
Right.
Do you use, let's say, some kind of engulfings or hammer shooting stars or gravestone dragonflies? I mean, those that they show the total shift in the momentum of.
Again, engulfing doesn't really work in Forex because for engulfing, you do need some kind of a gap. You have continuous price action, so engulfing are far and few. But some patterns are very effective, a doji, a hammer. There's something which I think it's called the crow pattern, but I call it the railway tracks, which I found to be one of the most effective. Just as an example, is if you have not a great example over here, but just those are the things which, if you see something like that on a 4 hour on a daily, you are very confident of a trade. When you have two absolute similar looking candles, so you have one green candle, this is a green candle, and you have another red candle of exactly the same body. The wicks might be different. So this is green and this is red. If you have two parallel candles together, I call them the railway tracks, it definitely gives you a certain shift of momentum, and you can definitely look for a sell in this case. So a couple of patterns which are effective. Again, as I said, not many patterns work in Forex, but on higher term time frames strictly.
Too much wisdom coming out of your explanations, and personally, I'm so happy that we have this moment to have you here again and explain everything from your experience and your high-level trading meetups as well. Yeah, because now it raises a lot of questions like, okay, how do they trade, speculate? I just read people's comment on the chat, and I'm very happy that you brought up this, because it can, a trader that is hungry just need to hear one sentence to build up his or her belief, to feel, hey, I can do it, and just to go through the process, right?
Absolutely, Theo. Unfortunately, today what's happened is, because of the vast reach of the internet, there's so much of information available today for free. Unfortunately, most of it is very general. Yes. This is something a lot of people I know, unfortunately, offer courses where if you do a Google search, you'll probably get the same information that they're charging you. Yeah. But there are a lot of people out there. So information is, I really don't blame a new trader, because when he or she comes into the market, everybody's talking about technical analysis and everybody's talking about indicators. So obviously, like I started, I remember I had purchased a couple of books. I still have the books with me. Reminds me today that what a fool I was in those days, but it's still with me, because I thought that was the way to go. Use technical indicators and you'll succeed in trading. It doesn't happen. My policy, honestly, has always been, I'm being very honest, I lose a lot of clients, in the sense I have people coming up to me, I need to be successful. How can I make money in 2 months? I said, you cannot. This involves a lot of patience, dedication, hard work. Give yourself 6 months to a year, follow the rules. If you do it, it's a business for life. And people say, but this guy's saying you can make money in 1 month and he's going to give me a system. I said, all the best to you. Unfortunately, there are a lot of people out there who do that. Trading is not that simple. And
exactly.
I always want to give them a correct path. That, okay, follow this path. It'll save you a lot of experience and money. After that, whether you make it or not, but at least you're following the right path. You're not going down the wrong path.
Exactly. And if you agree, I think based on our trading experience, and especially interacting with the markets a lot, all the information we knew, all right, I believe it was based on the stock market observations.
Absolutely.
And we have to deal now with the Forex market and the cryptocurrencies that they have totally different approach. They require a different mindset.
Right? Absolutely. Absolutely.
And you made it so clear only by saying that. I didn't think about that before. In Steve Nison's book, which I had the privilege as well to host him and talk in our market series, most of the the price patterns are with gaps.
With gaps, absolutely.
And that was also his observation with
right.
Back then. So can you explain us, because we have another, let's say, give it or take max 10 minutes, and I want to also ask the questions. Can you explain a little bit or summarize your 3M method?
Absolutely. I mean, this is something which I would want to do. So I follow the principle of something which I call as the 3Ms, and which I have learned from experience. And this has been my turning point. As I said, initially I used to use a lot of indicators till I threw away all the indicators and went straight for price action. Subsequently, I realized that it's risk management, which is one of the most important part. And then after that, I came to the realization that your mind factor also plays an important role. Today, all the systems that I have are based on the 3Ms, and I tell traders, let me first go through this. So the 3Ms are money, mind, and method in this order of importance. So money is simply your risk management policies. Your mind factor is what I simply call as patience and discipline. That's about it. And we'll go a little more deeper into that. The method is your trading system, whatever system you may use. Right now, if you break up these three factors, let's say on a scale of 1:10, your risk management takes up 5 parts out of 10. Your mind factor takes up 3 parts out of 10. And the method is only 2 parts out of 10. Now, you see, the method is the least important part of trading. And this is where most new traders tend to lose money, because they don't realize that. Again, as I said, it's not really that fault. Nobody really tells them that this is what you need to concentrate on. So this novice trader who comes in does not understand the concept of the money and the mind factor. And this trader concentrates only on the method. And within this method, he looks at indicators. So I would say out of 10 parts, this trader is following only 0.5 out of 10. And is it surprising that this trader loses money? It's not, because you're not following the correct method. Now, going deeper into this, so your trading technology, your methods, whatever, whether you're trading with fundamentals, with technicals, in technicals, you may trade with a moving average crossover. It doesn't matter at this stage. What matters is that unless you don't utilize or incorporate your risk management policies in your trading process, and you don't control your mind, which is the emotions, which again, we would like to talk about on a different scale, you're not really going to succeed in trading. And it's just as simple as that. I could give you the best trading system in the world. I could give you the holy grail of trading. But if your risk management is not correct, and if your mind factor is not correct, you will not make money, period. On the other hand, if my risk management policies are correct, and I have the correct mindset, I have the confidence, I have the patience to wait for my setup, and I have the discipline to follow my rules, I could trace with the toss of a coin. And I joke about this, that heads I go long, tails I go short, and I'll still make money, which is the importance of the 3Ms. So this
Exactly.
Very, very important.
Thank you so much for sharing.
Yeah.
At this point, because we are coming close to the end of this amazing webinar, honestly, I mean, it's amazing. Allow me to go back to our original screens.
Yep.
Okay. And let me just ask, oh my God, guys, so many questions. I'll just pick let's try to answer as many as possible for the next 5 minutes. So, how old were you when you started to live off Forex? Or maybe how many years ago? I mean, it's...
Oh, I'm
However
not.
you prefer to.
I'm not a very young man anymore. I switched careers at the age of 40, 35, actually 36, somewhere around that time.
Okay.
And well, it's never too late for anybody in life. It honestly took me a little more than 5 years to be consistently successful. But when I was past 40 or 41, I could say that my new career, I'm making money in my new career. So yeah.
Also, what are exactly speculative purposes? That's an interesting question, actually.
That's an
You can answer it in a...
Absolutely. So I'll give this to you from my experience when I was on the trading floor of the bank. So this head trader comes in. They had a group of about 6 to 7 Forex traders on the desk. The head trader comes in and says, I've got a commitment from a client that this client wants to sell pounds and buy US dollars, for some company he's exporting something, whatever. Now, so he's, let's say, buying GBP USD, just as an example, he's buying the currency pair. So this currency pair is at a particular level. Obviously, the bank gives him a competitive rate. The client will go to 5 different banks. So the head trader says, I have given him a rate which is lesser, maybe 5%, 10% than today. So you have to buy 500,000 or 500 million of GBP at this particular level. Now that's real trading. It's not speculative. So that is genuine trading. Now, what this bank trader does, prices, let's say at 1.5, I'm just giving round examples, okay? Prices at 1.5, and they want to buy it at 1.2. So the bank trader starts selling it, and they will drive it down to 1.2. In the process, make money selling the currency from 1.5 to 1.2. That is speculative trading. And
Awesome.
At 1.2, when he buys for the clients, 500 million goes to the client. Another 500 million is traded by the trader's desk because the trader's job is to make money for the bank. So he'll place his own orders. Speculative trading is when you're not trading for genuine export-import purposes, currency changes. You're trading to hold positions for 2 days, 3 days, maybe 4 hours, and just that's why it's called non-deliverable. I mentioned that the trading speculative is not deliverable. For deliverable trading, when you fulfill your client's condition, you deliver the money to the client. That's deliverable. Non-deliverable is you hold it for till it reaches your target. That's speculative trading.
Thank you so much. Another question, stochastic settings to use, please. 955. The standard stochastic on every platform is 533. I find the 955 to be the most effective on whatever time frame you are looking at to see the divergence properly. Now, divergence, you can even use a MACD or an RSI. For me, I use it because I can classify the class A divergence only by the stochastic, but the setting 955 works best. Okay, awesome. So guys, write this down. What is indicator that you use in the second window at the bottom of the chart? I think referring to the stochastic.
Okay, there is another indicator. It was a stochastic, but it's a different stochastic setting. That is my proprietary indicator, which I've developed it for MetaTrader. So I use it for a different purpose. So I have got different trading methods. There is a method which I have, which is called the hidden divergence. That double stochastic identifies the hidden divergence for me. And I am not going to give you the settings for that because that's a trade secret. Just kidding. But yeah, if you go to the slides, the settings are over there. It's not very difficult. Yeah.
So then you fix your target, your stop loss. Sorry, I don't understand this question. You fix your target, your stop loss is on 0.61.8 of FIP.
No. Okay. For the stop loss, we don't really use Fibonacci's. For stop loss, we use more of supply demand levels on previous levels of support resistance where banks have already taken out the stops. Targets, yes. Targets is based on Fibonacci levels, absolutely.
On Fibonacci extension, right?
Extension.
Oh, okay.
Absolutely.
Okay. Absolutely. And yeah, that's the, it's not the 0.618, it's the 161.8.
Exactly. Let me give you a practical tip over here. Honestly, no trade secret. The 61.8 is a very important level, definitely. There are 4 levels that we concentrate on more. And one is 78.6, which is actually a bank Fibonacci level used very well by banks. 61.8, 78.6. And on the extensions, 127.2 and 161.8. Just concentrate on these 4 levels. Price has an uncanny way of bouncing back and forth between these levels. Let me show you something about the Fibonacci's. Again, if we have time, something very interesting on harmonic patterns.
So we have 3 minutes to stretch it out because there is another webinar.
Okay. Anyway, harmonic patterns work precisely on Fibonacci levels. So people call it mumbo jumbo, the Gartley, the butterfly, but it's just a law of the charts. Literally, banks taking out the stops and on Fibonacci levels. So a Gartley is based on 61.8, 78.6. A butterfly is based on 127.2. And price respects these levels very accurately. Follow these levels. That's it.
I have a feeling that from next year we are preparing some other sort of webinars, and I'm sure you're going to be back with us, and you guys going to have more time. We're going to host some live webinars on trading, and we're going to go through charts and deviate some time, of course, to understand more the wisdom of Sunil. And the last question, guys, sorry, I couldn't go through all your questions. Some people, they said, amazing webinar. Mogil said, Theo, please don't end this webinar. No. Okay, so last question, recommendation for a beginner. And we end with this.
Okay. Well, follow the 3 M's, literally. You know what the 3 M's are. Concentrate on the risk management, concentrate on the mind factor. You know why it takes a trader a time to become successful? Because you may be good at your risk management, you may be good at technical analysis, but your emotions skill is also a skill which needs to be developed. Unfortunately, it gets developed by losing money and by experiencing losses. Take into account that you're going to have losses, learn from your mistakes, follow the policies, stick to a rule, have a trade plan. Just very briefly, I would like to, another reason why I see traders failing is they keep switching between systems. You start one system, it doesn't work, you go to another one, then you go to another one. You have to give the system time to prove itself. At least take 50 trades, if not 100 of the system continuously to see whether it proves, whether it works. Even if you are successful 50% of the time, it's a good system. People don't give it that. Have a trade plan, follow your policies, stick to it. You'll make it for sure.
Awesome. So at this stage, ladies and gentlemen, we came to the end of this amazing webinar, I can say. Would like to thank you so much, Sunil, for participating in this webinar. You really add so much value to everyone here. Myself and admirals, we would like again to say a big thank you for also every one of you guys that took the time and dedicate yourself to be in front of the screen to learn from this experienced and exceptional trader. In the meantime, on the chat, I'm sharing Sunil's website, the FIP Forex 123. Please visit this. Please have a look there. There is a communication. You can contact Sunil for anything you need there. I'm sure in the future we're going to have more webinars with you, Sunil.
It was a complete pleasure. Believe me, it was a pleasure. I love talking to traders and giving proper knowledge. If you go to my website, my email is there. It's just sunil@fibforex123.com. Feel free, everybody, to send me an email. I will always reply back. You don't have to be my student. You don't have to be part of my group. I'll always reply back. My intention is to see that you get the correct information to succeed. All the best to everybody. And I do hope to be back again with you. Theo, thank you so much.
It was a pleasure and honor, Sunil. Okay. Thank you. And have a great, great night. Thank you.
Thank you so much, Leo. Thank you, everybody. It's a wonderful webinar. I'll see you soon.
See you. Bye-bye.
Bye.